All right, welcome back for video 4 on chapter 1. I am going to, all this information is in the next few slides and I will toggle back and forth, but I just wanted to show you a little bit, kind of condense them for you or combine them. So the next objective talks about the accounting equation. This is the basis for everything we're going to do going forward. In accounting, everything has to balance. So our equation, which requires everything balances, is this: assets equals liability plus stockholders' equity. We're using the term stockholders' equity because, again, we're a public corporation. So we're going to define each of these elements, and I'm going to also give you an example. By the way, you can manipulate this equation and it would still be true. So if I asked you on a test, for example, if assets minus liabilities equals stockholders' equity, the answer would be yes, that's accurate, because all I do is subtract liabilities from both sides. So if you manipulate this algebraically, it will still be true. But this is how I will often present it in class. So let's take each of these components. So you know, I call them elements. Let's define them. An asset is an economic resource or a future economic benefit. As we go through the course, you're going to become more familiar with the various accounts that are assets. So as I define each of these for you, over the course of the next few chapters, I'm going to give you in accounting, we deal with various accounts where we capture the information depending on what the item in the financial transaction is. So some accounts that you're going to work with and hear about that are assets include cash, accounts receivable. Let me make that a little wider. Actually, it should be good. Merchandise inventory, land, oops. Actually, I'm going to put first notes receivable, land, machinery, equipment, they go together often. Office supplies. These are just a few. We're going to add more to them. Here's my suggestion. I make this suggestion in the live classroom as we're introducing these elements. The asset category is the element. You need to know all these accounts I've listed here that they are in fact assets. Because in chapter 2, when I start to introduce you the rules of debits and credits and how we record things, you have to be able to, through memory, identify, oh, this is an asset, so these are the rules it follows. So if you keep a listing now, I think it will help going forward with, you know, memorization and understanding the rules. So we're going to add to this list, but please just start keeping a list. So an asset is a future economic resource or benefit, and here are some items. So when we talk about cash, every business has cash. They have a bank account, they have money in their checking account. That's considered cash. If I have to write a check, pay a bill right now, I'm going to pay it with my cash. So your checking accounts, petty cash, things you have lying around, that's all considered cash. Whatever the total of that is included in your cash account. Accounts receivable is an account that tells you who owes you money. Your customers. You sell a product, I sell lamps. Some people come into my store and they pay me directly when they buy the lamp and they leave with the lamp. Some people, I will give them credit and they'll pay me, let's say, in 30 days. Those people I have to keep track of in the account called accounts receivable, or rather the amounts and the people, but the amounts that I am owed. I haven't been paid yet, but I am owed based on what I've sold, and customer owes me money. That's kept in accounts receivable. Inventory is the cost of the items that I sell in my business that I have in-house. They are available to be sold. Notes receivable is like accounts receivable. It is that little more formal. So I sold someone some lamps, and I had a paper. I had them sign a paper saying, okay, you don't have to pay me now, but you have to pay me in 3 months on this date, and I'm going to charge you 5% interest. Here's the total you'll owe me. So it's a little more formal, something written up, and we'll see that as well. Land is if I own any land in my business. We'll talk about that more, right? The value of that land is included in my land account. Machinery, equipment, same thing, depending on what I do for a business, machinery to make my product, or a Xerox machine or anything like that, a shredder, things like that. Those are all included. The cost I paid, remember the cost principle. So the cost I paid for them are included in my machinery and equipment account. Office supplies, we're going to talk about a lot throughout this course. Those are ink, pens, pencils, erasers, pads, whatever, clips, Post-its, things that you buy to help you complete your work. And the value of those brand new are recorded in office supplies. You'll see by chapter 3, we're going to focus a lot on office supplies and what happens to those office supplies as we use them and they're no longer available for our use. So these are assets. They're available to us to use in the future to run our business. Okay, so let's talk about liabilities. Liabilities are amounts of money you owe as a business. Okay, they're your debts, your obligation. Often, not always, but often they include the word payable in them. So if some examples, some accounts that are liabilities are accounts payable. I'm going to put notes payable, salaries payable, insurance payable, rent payable. There's so much. Here's one without the word payable. Unearned revenue. Unearned revenue is one of those outliers where it doesn't have the word payable, but it is in fact, and we're going to focus on that a lot as well. So these are all accounts payables are the bills that came in. I get my electric bill in the month. I get it in December, and it was for the electricity I used in November. I'll pay that within 30-day time frame. So I have it available. I record it. It is an accounts payable. Notes payable, again, is money I owe. Someone lent me money, but it's more formal. I signed a document. I signed a note, right? The bank lent me money to buy some land. I signed a note. I owe them money at the end of the year with so much interest. That's a notes payable. Salaries payable. Those are the money my employees have worked. The time has passed. I owe them their salary. I've recorded it on the books at the amount of money I owe them. Insurance, rent, same kind of things. These are money I owe to the insurance company, the rent company. Unearned revenue, which is a little different, is money that a customer pays me in advance of me delivering the product to them. So they paid me before I satisfied my end of the obligation. So you get the idea, and we will review these again as they come up, because we're going to review many transactions before the end of this chapter where we use most of these accounts. Okay, so again, liabilities are amount of money or debt that we owe. I switched back to the slides just for a quick moment because I want to introduce you to the idea of equity or stockholders' equity. It has two components, contributed capital and retained earnings. So I'm going to put that on our sheet, but I really want you to see on this slide how there's two big parts. Okay, it has two pieces to it. And then under each piece, we'll talk about the different accounts. So for contributed capital, when I write that, it's going to be mostly common stock. That's the account. And for retained earnings, oops, again, I went too far. Right? Retained earnings are going to include revenues, expenses, and dividends. Okay, so here we are back at our Excel spreadsheet. I have stockholders' equity. I've broken it down for you. The two components of stockholders' equity are, again, contributed capital and retained earnings. So when I speak to you about someone is buying into the company, they're buying stock on the open exchange, that transaction is going to partially be captured under our common stock account. So again, when stock is purchased, it's common stock. Okay, so typically in this class, when we see this, this will increase. I am going to abbreviate stockholders' equity as SHE. Okay, so that common stock will increase. This common stock transaction will increase stockholders' equity. Oops, I'm just trying to. Let me just put the abbreviation here for stockholders' equity so you know, SHE for stockholders' equity. The second part of stockholders' equity is retained earnings. So the three accounts under retained earnings are revenues, expenses, and dividends. What are revenues? Revenue is the money we earn from selling our product or good. Once we deliver that product or good, once we've satisfied our obligation to the customer, we can call the money earned from that revenue. Keep in mind, because we're going to see this again in later chapters, as long as we've done our part, we can call it revenue. That means if the customer pays me or owes me, it doesn't matter. As long as I have done my part in delivering the product, I am going to record revenue. So if I have a lamp that I sell for $100 and a customer comes in, buys it, and I give them a note, they're going to pay me in a month, then I am still recording $100 of revenue. I'm saying I earned it, even though I don't have the actual physical cash yet. We'll talk more about that. But revenue increases stockholders' equity. So expenses are the cost of doing business. It's everything you have to pay for. Paying salaries to your employees, buying insurance, rent in your building, or a mortgage, or whatever it is. Not really a mortgage, but maybe interest on a mortgage, things like that. Those are expenses of running a business. So like revenues, it doesn't matter. Remember that utility bill I spoke about when I discussed accounts payable? So even though I have that bill, I haven't paid it yet. That bill was for a month that passed. It's still an expense because it was incurred, and you'll hear that word a lot, incurred. And since it was incurred, whether I paid for the bill or not yet, I am going to label it an expense. And an expense decreases stockholders' equity. Okay. Dividends, likewise, are money from our earnings. When a company creates, is making money, a lot of times the board of directors will decide we want to give back to the stockholders, and they'll pay them a dividend from what they've earned. This also decreases stockholders' equity. Okay, I'm going to stop this here and continue on the next video.